Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. Because of what has been going on in early 2023 with US and Swiss banks getting into trouble, and because of this question, would platforms such as Wealthsimple or Questrade be affected upon a failure? Or are banks more at risk because they, quote, gamble with deposits? Or do said discount platforms also invest in cash balances? I decided to do a summary of the insurance on the deposits in Canada protecting Canadians from bank failures. Also, I wanted to compare banks to the US banks, and finally look at Canadian investment brokerages and what insurance covers them, and answer the question, are they safe? Let's look at Canadian banks first. What happens if my bank goes under? First of all, it's super unlikely that a Canadian bank would become insolvent. But in the event that this happened, the Canada Deposit Insurance Corporation, CDIC, provides some insurance to depositors. Canadian bank deposits are generally eligible for insurance up to $100,000 at each CDIC member institution for each category. Note that these need to be savings or GICs. Your savings accounts gets $100,000, a joint savings account gets $100,000, and you get a separate $100,000 for each of TFSA, RSP, RIF, RESP, or RDSP savings accounts. Check on cdic.ca to make sure your institution is a CDIC member. What's covered? Deposits in Canadian or foreign currency, including via payroll, Interac, e-transfer, or check, guaranteed investment certificates, GICs, and other term deposits. What's not covered by CDIC is mutual funds, stocks and bonds, exchange-traded funds, and cryptocurrencies. For folks who have more than 100,000 in CDIC member institutions, what happens to the money depends on a few factors like the account type. However, you may consider just opening additional accounts at different CDIC protected institutions or buying Government of Canada short-term bonds. The institutions will each have a fresh set of 100,000 accounts, and the bonds will never fail unless the government does, where there's going to be far more problems than your cash being unavailable. Just so you are more assured that we won't have the same issues in Canada as with the US regional banks, Canadian banks have constructed sophisticated and savvy treasury departments, and part of their job is to mitigate interest rate risk, which is what caused problems in the US, and they will mitigate this risk as best as they can. Treasurers are charged with asset liability management to lessen the duration mismatch that otherwise could occur unchecked. Canadian banks, like largest cap US banks, are subject to much tighter regulatory oversight compared to the US regional banks. There are far fewer banks in Canada, and it is easier for regulators to stay on top of them. And they are far more important because they are all, quote, too big to fail. US banks under 250 billion in assets have even less oversight and regulations to adhere to, such as liquidity requirements, just because they're smaller. The regulations are according to the complexity of the bank's operations and their size. Annual stress tests on capital levels, as well as so-called horizontal stress tests of bank liquidity, are performed annually in Canada. No such oversight existed for Silicon Valley Bank, the first to fail in early 2023, as its assets were below the required 250 billion asset threshold. Additionally, both regimes require extra buffers on capital. For instance, in Canada, the Big Six are required to hold an amount of regulatory capital and bail-in debt, known as total loss absorbing capital, of at least equal to 21.5% of their risk-weighted assets. Finally, the Canadian banks, like their largest global peers, are held to a general liquidity standard, or what is known as liquidity coverage ratio. The banks must have on hand at least 100% of an estimated cash flow draw over a 30-day period. Canadian bank LCRs range from 122% to 151% at 31st January of 2023, compared with JP Morgan Chase at 112% on 31st of December 2022. Please note that just like in the US, we operate a reserve banking system where banks have only a small percentage of clients' deposits on hand and invest or loan out the rest. That's how they make their money. If all the depositors wanted all their money all at the same time, any bank in the world would fail. There has to be faith and confidence in the bank so people don't rush to pull their money out. Will you ever need to know all of this info? As a Canadian, probably not. Between 2008 and 2012, during the banking crisis, 465 banks went down in the US. In Canada, 0. US banks fail pretty frequently, while the last Canadian failure was on June 4th, 1996, when about 2,600 Canadians discovered that their savings were not immediately available from their small financial institution. They had entrusted a total of $42 million in deposits to a Calgary-based Security Home Mortgage Corporation, which had closed its doors for good. If you are still worried and you have more than the insurable deposit limit at a single bank, you could consider spreading that money among different accounts at different banks. Otherwise, let's hope we'll all be watching paint dry for a long time. So what about investments and Canadian brokerages? What happens if they were to fail? This will answer the original question posed at the start of the video. Investments work differently than bank deposits. Stocks, bonds, ETFs, and money market funds, those are all assets you own. They're held in trust for you in your name at places called custodians. If anything happens to those companies, those investments still belong to you. They don't get loaned out the way a bank loans out cash. These assets are often insured as well, in the case by the Canadian Investor Protection Fund. Go to CIPF.ca to check out its member directory. CIPF insures against their members getting into trouble with a much higher limit of $1 million distributed per member institution in the following way. There's $1 million for all general cash, margin, and TFSA accounts combined. $1 million for registered retirement accounts like RRSPs, RIFs, and LIFs, again combined, and $1 million for RESPs for the kids' education. If you have a corporation, that gets its own $1 million as well. So if we have more than one brokerage and multiple types of accounts, there should be no problems with the $1 million limit per account per institution. Note that the $1 million is against the brokerage failing, not your investments losing value. You're on your own for that. So to summarize, our big Canadian banks are well capitalized and safe. And if you have over $100,000 in cash, spread it around to different banks to take advantage of the insurance. The same goes for your investments in brokerages, except you can have $1 million insurance per account, per brokerage, and still be covered. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.